Hi, it's Andrew here with ABC Media Company again. Recently, I've had a request on how to determine from a client to determine whether a company was worth investing in. So today we're going to be kind of looking at the best way to determine how to invest in a company financially. So we're going to be looking at income statements and balance sheets. Those are the best ways to tell whether a company is worth investing in. One of the best ways to determine ratios. So we're going to be looking at Yahoo today, which I recently did a study on uh, between Google and Microsoft, which are its main competitors. So the first thing when you determining ratios for a company to see if it's worth investing in is you want to look at its profitability ratios, which tell how much money it's making, how many sales it's generating based on income, net income to sales. So one of the first things you want to do is look at return on assets. And return on assets basically tells you how much much revenue you're generating on your assets that a company owns. So that kind of tells you, are the assets worth having? And Yahoo, we'll be looking at, let's see, Yahoo in 2015. And its profitability in 2015 is actually a negative 9 points, or its return on assets is a negative 9.64%, which isn't good. Microsoft and Google, both in recent years, have generated a return on assets of Microsoft with 6.92% and Google with 11.07%. So that's pretty awesome for them. Yahoo, not so much. The next thing we're going to look at is the return on stockholders' equity, which basically tells how much. It basically tells how much money is being earned with the investors after all the expenses are paid. So net income to stockholders' equity is what that is. And Yahoo in 2015 had, once again, it was a negative 15.01%, which not good again. You have not stockholders basically would be better investing elsewhere. Microsoft had a 15.23% return on stockholders' equity, and Google had a return on stockholders' equity of 13.91%, which is pretty awesome. The next ratio we look at is operating profit margin, which basically tells you, how much money after you pay for your cost of goods and your operating expenses, how much after that kind of compares it to gross sales. So kind of the percentage of sales after those expenses are paid. So Yahoo in 2015 has an operating profit margin of negative 95.58%. In recent years, last year it had a 3.10%, and the reason they were actually much higher last year is because they had a sale on assets. So that when you look at Microsoft, they had an operating profit margin of 19.21%, and Google had an operating margin of 24.99%, which is pretty phenomenal. Next key statistic in profitability ratios we'll look at is net profit margin or return on sales. So when you look at net income after all expenses are paid, very basically the bottom line of the income statement, and you compare that to the gross sales of the company. And when you look at Yahoo in 2015, they had a negative 87.74% net profit margin or return on sales. So their company is making negative money. They're not doing well at all. They're basically double in the hole of what the sales they made. Microsoft, on the other hand, has a net profit margin or return on sales of 13.303%. So after everything's been done, they have that to either reinvest in the company or to disperse amongst shareholders as dividends. Google had a 21.88% net profit margin, which is pretty awesome too. So 1/5 of their sales basically goes back into the company. Next thing we'll be looking at is liquidity ratios, basically how quickly a company can pay off its quick assets or quick liabilities with its quick assets, basically. So the current ratio tells how quickly a company can pay off its current liabilities with its current assets. So when you look at Yahoo in 2015, it had a current ratio of 4.75 or 4.80 basically, which is actually pretty good. Actually, I lied. That was Google. Let's see. Yahoo's still not doing too bad though. They have a 5.87 current ratio. So they're basically able to pay their current liabilities with their current ratio or current assets 5 times over. So current assets are basically some assets that can quickly be converted to cash. So it would be cash, accounts receivable, inventory. And then a quick ratio basically is that same ratio without the inventory included. So, you know, the inventory is kind of, so it's not, it's semi-liquid, so it's harder to get rid of because you have to sell it. And Yahoo has a quick ratio of 5.88, which is still pretty good. So they're able to pay off their quick liabilities, their current liabilities relatively quickly with their current assets without the inventory included, which, you know, there's no heavy inventory cost for them. They don't have heavy inventory, which is why they have such a good ratio in that aspect. Next thing we'll look at is leverage ratios. So debt to asset for Yahoo in 2015. So the assets are funded with roughly 35.75% debt, which is pretty good. Could be better. Their debt to equity, not so good. It's 55.64%. So they're basically, when you look at that, I have to pull it up here. It will pull up. So they have 50% of their debt is basically equal to the shareholders' equity. One more thing we'll look at real quick is fixed asset turnover for Yahoo in 2015. Now, this doesn't encompass all the ratios there are out there, but some of the more basic ones that are used to determine whether a company is financially solvent or worth investing in. So, let's see, Yahoo in 2015 had, can't seem to find it anymore. Yahoo in 2015 had a fixed asset turnover in 3.21, so basically they're turning over their assets they're earning $3.21 per dollar of assets, which is pretty good. Comparatively to Google, though, as of recent, they have an fixed asset turnover 2.76, so they're doing better than Google. Microsoft has a fixed asset turnover 6.35, so it's double better than Yahoo. So today that we just covered quickly what the best ways to kind of determine whether a company is worth investing in by simple financial ratios. Thank you.